Hi guys, I'm Tyler Laundon, Chief Analyst of Cabot Small Cap Confidential and Cabot Early Opportunities, and I'm here with your Cabot Weekly Review. We are recording this around 12 Eastern on Friday, December 9th. As far as what we're going to talk about today, we're going to start off going over some of the macro data news from the last week. We're going to get into a little bit of what we expect next week with the FOMC meeting, and then wrap things up talking about three small and mid-cap stocks that screened well based on acquisition potential. So starting with what we see going on today, S&P 500 chart right here. As you can see, we're up a little bit on the day. I put this green circle around basically the last couple of weeks because as you can see, last Wednesday, that's this blue spike. This was when Jerome Powell was speaking at the Brookings Institution and just was less hawkish than kind of the market expected. And so had a nice rally, but that began to fade heading into the end of last week. And then what kind of set the tone for the current week was last Friday, we had the November payroll numbers that came in stronger than expected. And it was especially true for wages, which the Fed definitely does not want to see. They don't want to see strength in wages. They want to see quite the opposite right now. Thankfully, FOMC members were not allowed to speak this week due to blackout ahead of next week's meeting. So we didn't hear much from them or anything from them. But in terms of the data, so we kicked this week off on Monday morning, the November non-manufacturing purchasing managers index came in stronger than expected, which is good for the economy, but bad for the market because, you know, we're in this environment right now where good economic data is kind of bad. As we moved into the middle of the week, we began to hear more calls from big bank CEOs about how they think a recession in 2023 is now a lot more likely. So that started on Tuesday. JP Morgan Chase CEO Jamie Dimon talked about recession risks rising. We also heard that Morgan Stanley was going to slash 2% of its workforce. On Wednesday, the CEOs at Wells Fargo and Bank of America came out, said they're seeing slower consumer spending and borrowing. Obviously, that's bad for the economy, which is really consumer driven. It might be good news for the Fed, but not necessarily for the market. As we get closer to the end of the week, on a somewhat positive note, we get an update on the Investors Intelligence Bull-Bear ratio, which is super low at about 1.3. That's bad, except for from a contrarian perspective, it's kind of good. Historically, bad readings around 1 have translated into good buying opportunities. And that ratio has been depressed for a little while. We haven't seen the benefit of that bad, in quotation marks reading yet. But if we look back in time, it is kind of good to be buying when that bull bear ratio is low. Also low small cap stock valuations. Again, sounds bad, but like the bull bear ratio, it's good from a buyer's perspective. I'm continuing to see a lot of notes from big bank analysts about how small caps are pretty well poised for a big year in 2023. A lot of that comes down to relative valuation. They're cheap as compared to large caps. And even when you take out the mega caps from the large cap index, small caps are still looking pretty cheap. Fast forward to this morning, Friday morning, we get the PPI numbers. That's the producer prices. They're a little bit stronger than expected. It's not going to be great news in the eyes of the Fed. This morning, when that number came out at 8:30, we saw futures, which had been up, go into the red a little bit, although now as we are here at about midday, as you can see, the market has digested it pretty well. As far as next week, it's going to be a big week. On Monday, we get CPI, that is consumer prices, so big inflation index there. And then on Wednesday, the FOMC wraps up its meeting, has a press conference. The current odds are at about 77% that we're going to get a 50 basis point hike. I think investors are going to be listening pretty closely to what the Fed expects to do next year. The next meeting after next week's isn't until February 1, and current odds are 50% in favor of another 50 basis points, but that number is likely to change based on what the Fed says next week. I think big picture, we step back. It's kind of unlikely in my view that we're going to see much of a change in character with the market through the beginning of the new year, just because we're still in this, are we going to be settling out with a Fed funds rate at around 5? Is it going to be 5.25, 5.5? What's the deal? I think until we get some clarity on that, the market's just going to continue to be kind of range bound, although I'm sure we're going to have some little rallies here and there, and hopefully a little bit of year-end rally, which if we look at the data going back, over 50 years does tend to happen. So, okay, that's the macroeconomic stuff. Let's talk a little bit about stocks. So I was going through some data earlier this week from Bank of America, and I came across a list that they had of small and mid-cap stocks that they say screen well for acquisition potential. Now, of course, I never recommend a stock in either Cabot Early Opportunities or Cabot Small Cap Confidential purely because we think it's going to be taken out. But having that potential is certainly an added plus when we're looking at a company that has a lot of other things going for it. I did write an article about this a little bit earlier in the week, and that is up on the Cabot website if you want to check that out. But we're going to go over those three stocks today. They're all in the healthcare space. One is a med tech stock, and the other two is a biopharma, and one is a biotech. So before we get to that, I think I have a chart of, so here's the yield on the 10-year. You can see it's come down pretty markedly over the last month and a half. And this dip right here was when Jerome Powell was speaking last week. So that's what the 10-year is doing. S&P 600 small cap index. Still looking for it to get up into this range of around 1230 to 1300. But it just hasn't been able to get there and stay there yet. Okay, onto the stock. So we're going to start off here with Halozyme Therapeutics. It is a biotech company, and it has developed a drug delivery platform that's called Enhance that is used to deliver injected drugs and fluids. As you can see up here, market cap of just under $8 billion. And this was on Bank of America's growth at any price M&A screen. So the key part of Halozyme is Enhance. It's the company's proprietary enzyme, which works by breaking down a naturally occurring carbohydrate that is in tissues, helping them to improve and disperse injectable biologics. So what this basically means in layman's terms is that treatments that were previously delivered via IV can now be delivered just under the skin using this Enhance enzyme. So Halozyme makes money by licensing its technology to biopharmaceutical companies and collaborating with them to develop products that combine Enhance with their own compound. So big picture, what this means is that it kind of has a lower risk profile than a lot of other small and mid-cap biotech companies just because it has this really diversified revenue stream. We're not going to get into all the different treatments that are out there, but just, what we see is that Halozyme has licensed Enhance out to a lot of big companies, including Roche, Pfizer, Janssen, AbbVie, Lilly, Bristol Myers, argenx, and Horizon Therapeutics, and there are several more. In terms of growth, so revenue was up 66% to $443 million last year. That's 2021. And we are looking for revenue to be up around 53% this year, and then another 31% in 2023. You can see some of the more recent quarterly growth rates here at the bottom of the screen. And then, as you can see here, if we move up a couple of columns, Halozyme is profitable. Earnings in the last quarter were 74 cents per share. So that's Halo. Next up is AXNX. Ticker symbol is AXNX. Market cap here is about $3 billion. And this was on Bank of America's growth at any price M&A screen. So AXNX, what they do is they specialize in developing devices for sacral neuromodulation, abbreviated it's SNM. If you see that on their website. It's a treatment for overactive bladder and incontinence. Basically, these devices are implanted in the body and they send low amplitude electrical stimulation to the sacral nerve, thereby restoring normal bladder and bowel control. So this market, it has traditionally been led by Medtronic, the huge medtech device company, MDT. But AXNX really did a pretty good job of coming out with a better system One of their devices is called the R15. It's small, rechargeable. It's MRI compatible, works for up to 15 years. It does have to be recharged after a month or two. But then earlier this year, they came out with what they're calling the F15 device, and it's a recharge-free device that they say works for up to 10 to 20 years. So pretty disruptive solution. As you can see, the stock has been doing okay, a bit of a pullback from its high in September, which was just shy of $80. But so far, holding above its 200-day moving average line. Growth is definitely pretty impressive. So revenue last year was up 62% to 180 million, and consensus expectations for this year, 44% revenue growth, and then 27 to 30% in 2023. AXNX is not profitable. Expected EPS loss this year is about $1.50, $1.56. Whenever we're thinking of small medtech companies that need cash, funding is obviously a concern. We did see the company go to the market with a secondary offering back here in August, priced at 66, which is just a little bit above where the stock is trading right now. But I think, can't remember the exact number, but I think they brought in 120 million or something like that. So they should be funded for a while. EPS is trending in the right direction. While it's not profitable, we should see about a 40% improvement in 2023. All right, last but not least, here is Catalyst Pharmaceuticals. Ticker symbol here is CPRX. Market cap of about 1.7 billion. So it's another small cap biopharma company. It was on Bank of America's value M&A screen. What they do is they focus on in-licensing, developing and commercializing novel medicines to treat rare diseases. So the deal here is we go back to 2006 when it came public, but the reason really that Catalyst is doing well now is because in 2012 they struck a collaboration deal with BioMarin, ticker symbol there is BMRN, and Catalyst obtained North American rights to a compound that was under development for the treatment of LEMS. So LEMS is a neuromuscular disorder, causes severe and progressive muscle weakness and fatigue. Basically, it happens when the immune system disrupts communication between nerves and muscles, and this important chemical ACH can't be released. That impacts muscle function. So LEMS impacts about 3,000 people in the US right now and many more worldwide. So in 2018, Catalyst was able to obtain FDA approval for this compound. They commercialized it. The name, which I'm going to butcher probably, is Firdapse. That launched in early 2019. As of now, it's available for adults and children as young as 6. Canada has also approved treatment for adults. So pretty impressive growth profile here for Catalyst. So sales were up 18% in 2021, but now things are really cranking. So revenue should be up around 50% this year to around 210 million. Third quarter sales were up nicely, almost 60%. As we look out into next year, early consensus estimates are for around 20% in 2023. And the company is profitable as well, as you can see. If we go down, if you can see these numbers down here, in the last quarter, earnings per share, 26 cents per share. All right, guys, that's it for me. As always, do your own research if you intend on buying any of these stocks. Hope you have a nice weekend, and we will be back in touch next week. Take care.